Hi, I'm Richard Murphy, and this is the 14th in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we're exploring the importance of properly budgeting the tax revenues that a government seeks to raise. Like the previous videos in this series, this one is largely based on material in a publication called Making Tax Work that Professor Andrew Baker of Sheffield University and I wrote on behalf of the Global Initiative for Fiscal Transparency, and which went on to underpin its transparency principles for tax policy and administration. Making Tax Work is a free download from the GIFT website. The budgeting exercise referred to in this video assumes that the tax strategy referred to in video 13 of this series exists. It would be wise to watch that video before this one in that case. It stressed that a tax strategy and the budget for tax revenues are heavily related documents. That is because the tax budget explains how a tax strategy will be delivered in practice. An agreed and published tax strategy should frame all the decisions in an annual tax budget. It is important that any tax budget be prepared in sufficient detail so that outcomes can later be compared with expectations. The maxim that might be applied to the process is, show your workings. Unless this is done, it is unlikely that those seeking to appraise how well the tax system works, which is the goal of tax transparency, will be able to do so in the detail that they desire. The budget for tax revenue to be raised by a jurisdiction for a period should state for each tax that it is proposed to be charged. Firstly, how many people, including companies, are believed to be liable, at least in principle, to make payment of the proposed tax charge, either as principals in the case of direct taxes or as agents in the case of indirect taxes. Secondly, how many people are actually expected to pay each tax, which will always be a smaller number. Thirdly, how much tax is expected to be paid with regard to each proposed tax, split in a way that might indicate the anticipated contributions to be made in bands that illustrate the sums paid by those with differing incomes, wealth, or levels of expenditure, as might be appropriate, with details of the bands in question being disclosed. Fourthly, what value of allowances, reliefs, and exemptions are planned to be provided with regard to each tax, and who is expected to benefit from these, split between the bands used to explain the relative contributions to revenue made. Fifthly, what the tax gap for each tax is expected to be, split between tax evasion, tax avoidance, and bad debt, in other words, those sums that are simply not collected. And last and sixthly, how much of the tax authority's total revenue is to be spent on collecting the tax in question, and how many people might be expected to be employed in that process, and at what cost. As an example, in the case of a corporation tax, the following detail might be required from a budget. In this example, it is assumed that corporation tax is charged at two rates in the jurisdiction. Small companies with profits of less than 1 million units of currency are assumed to pay tax at a rate of 15% on their profits, whilst larger companies are assumed to pay at 30%. Then it is assumed that there are 500,000 companies in this country. 400,000 of these are small. The average taxable profits of a small company are 300,000 currency units. The average taxable profits of a large company are 2 million currency units. Tax allowances and reliefs reduce the average profits of small companies by 100,000 currency units to reach the above figure. Tax allowances and relief reduce the average profits of large companies by 1 million currency units to reach the above figure. 15% of all small companies and 10% of large companies are expected to evade their entire tax bills. The corporation tax of the jurisdiction is expected to cost 45 million currency units to collect. The resulting budget for this tax would look like this. The table is laid out in the easiest possible way using the data provided. This is vital to assist users to understand what is happening. These tables will need to be carefully designed for each tax. When stages in the calculations are required, for example, to show the way in which the cost of tax reliefs is calculated on the way to estimating the total tax due, then the necessary workings are shown to help anyone recreate them. This is an essential part of tax transparency. Key assumptions, like the rate of tax evasion, are also highlighted. I stress that this approach might be a little simplified from the actual calculations that a tax authority might undertake, but it is important to note that there is also merit in that. Tax transparency is essential, but so too is protecting taxpayer confidentiality. An approach of the sort noted here should avoid conflicts arising for that reason. It will almost invariably be the case that some of the above estimates are based on assumed changes to tax law. The process of transparently securing approval for these is discussed in video 15 in this series. What is vital about any tax budget is that it is published. It is subject to approval by a parliament. There is an opportunity for legislators to debate this budget. Others in the jurisdiction should have the right to make representations on the budget and the budget process. Detailed budgets of the sort noted are an essential part of the process of tax transparency, and that's why we place so much emphasis on them.